Hello, all. Welcome to today's session on investment declaration and proof submission. My name is Yeshwar Kotroy, and today we have Rahul, who is a tax expert, with me. Rahul will be addressing your questions if you have any during this webinar. After the webinar is over, we are going to have a quick question and answer session wherein we will be answering your questions. Now, before starting, let's try to, or rather, let's go through the topics that we would be covering today. Firstly, we are going to understand who should be filing their income tax return and when it needs to be done. Secondly, we are going to take a walkthrough between both the regimes, new tax regime and the old tax regime. We are going to explore the tax saving expenses, tax saving declarations. We are going to look at one of the tax saving instrument, that is ELSS, how tax saving can be done. Now, first and foremost, we are going to take a look who should be filing their income tax return and when it needs to be done. Any person who has an income more than 2.5 lakh rupees before claiming any deductions, that person needs to be filing their income tax return, even though that person need not pay any taxes, because up to 5 lakh rupees, one person need not pay any taxes because of Section 87A rebate. However, if your income is crossing 2.5 lakh, you should be filing your income tax return because it will create a track record. Secondly, there are situations wherein a person's income is falling way below 5 lakh rupees, but some of the income that person may be having, some tax has been deducted. So the by virtue that person's income is way below 5 lakh rupees, he should not be paying any taxes. Therefore, he is liable to get his TDS amount back. However, TDS amount cannot be given to that person until and unless that person has submitted an income tax return. Therefore, if you want to get a refund, you should be filing your income tax return. Thirdly, many person enters into a capital gains transaction. They get into purchase and sale of shares, mutual fund units, etc., etc. And those person, if they are incurring any, in case of they are incurring any profit, yes, it needs to be shown in their income tax return. But if that person has some loss, in that case also, income tax return needs to be filed. However, here lies a question. I have not earned any income, right? So why should I be making this report in my income tax return? To answer this, simply, if you have a capital loss this year, then if you file your income tax return within the due date, you will be able to carry this loss forward, right? So carry forward means in this year you incurred a loss, but in coming years, if you earned an income of the similar nature, this carry forward loss can be adjusted with profit of that particular year, right? Particular future year. Therefore, it's in your benefit, you should be filing your income tax return to carry forward the losses. Further, if you are filing your income tax return, then you will be spared of paying penalty interest, late filing fees. Further, since you are filing your income tax return, you are building your portfolio, and it will be very easy for you to getting a visa. Now, the due date of filing the income tax return is 31st of July of each assessment year. Presently, we are in the assessment year 22-23. Therefore, the ITR filing's due date was 31st of July. However, in case there are two options even after 31st of July. Number one, you can file a revised tax return, and number two, you can file a belated tax return. Now, belated tax return, what happens is if you are not filing the income tax return within the due date, the department allows you some extra time to file your income tax return, provided you are paying some interest and late fees, right? And reverse tax return means if you have filed an income tax return earlier, but you notice there are certain discrepancies in that income tax return, you can again go ahead and file a revised tax return showing the corrected information and incomes. Now, Uh, the revised tax return and belated tax return, the due date for both of them are 31st of December, right? If you are not filing your income tax return within that due date, you cannot file belated tax return or revised tax return. Another thing I would like to mention over here is if you are filing a belated tax return, in that case, you cannot carry forward any losses. Now, having understood the due dates of filing the income tax return, let's go through understanding of the new tax regime and how is it fares to the old tax regime. First and foremost, new tax regime is a tax regime wherein you are not allowed to take any deduction of any kind apart from a very few. However, by taking away those deductions, the department actually allows you to pay taxes at a lesser rate, right? So we know India has a progressive taxation system. So if you earn a higher income, the slab rate changes based on the income that you are incurring. So under the new tax regime, the slabs are much more closely stacked, and rate increase is also not as steep as the old tax regime. However, despite that, there are no takers, or rather, very few takers for the new tax regime. Why? We are going to take a look at this live scenario wherein there is the number. We have taken a hypothetical situation wherein a person is staying in a rented place in a different city, right? And his salary structure, that person's salary structure is segregated in three parts: basic, house rent allowance, and other allowance. That person is paying rent at the rate of 20,000 rupees per month, right? Now, uh, all in all, his income is 10 lakh rupees. Income from salary is 10 lakh rupees. Now, under the old tax regime, if we see from 10 lakh rupees, that person will be able to reduce HRA because he is staying in a rented place for his employment purposes and he is getting some allowance from his employer. Therefore, HRA can be allowed to that person. Secondly, standard deduction of 50,000 is allowed. Thirdly, tax on employment or professional tax. Again, it is also deductible up to 2,400 rupees. So all in all, these three deductions combined, his total salary is coming to 7,57,000 rupees. Whereas under the new tax regime, no such deductions are available. Therefore, the 10 lakh rupees of salary will be taken as 10 lakh rupees. Further, under ATC, that person has LIC premium, ELSS mutual fund investment, SSY, Sukanya Samriddhi Yojana, uh, Provident Fund, Employer Provident Fund, and medical insurance. Right? All these taken together, that person's salary is coming to 6,19,000 rupees. Whereas under the new tax regime, no deduction of any kind is allowed. Therefore, his taxable salary is still at 10 lakh rupees. Now, we have understood, or rather, we have gone through the income computation. Let's try to come to the tax computation part, right? Because that is the main area of comparison between these two regimes, right? So, under the new tax regime and old tax regime, up to 2,50,000 rupees, there is no tax. Why? Because there is the rate of tax is zero. From 2,50,000 rupees to 5 lakh rupees, the rate of tax is 5% under both new and old tax regime. However, here the difference starts. Under the new tax regime, from 5 lakh to 7.5 lakhs, rate of tax is 10%, and from 7.5 lakhs to 10 lakh rupees, the rate of tax is 15%. Now, all in all, total tax payable is coming to 75,000 rupees. However, under the old tax regime, uh, beyond 5 lakh rupees up to 10 lakh rupees, the rate of tax is 20%. However, we need to see how much increase is present beyond 5 lakh rupees. Based on our deductions and everything, I can see my incremental salary is only 1,19,000 rupees, right? So only on 1,90,000 rupees, we will be charging the taxes at the rate of 20%, which will be around 24,000 rupees, right? So all in all, we will be coming to a tax computation of 38,000 rupees. If we 36,000 rupees, if we add the education says my total tax liability would be 37,750 rupees, whereas under the new tax regime it will be 78,000 rupees. So there is straight away tax saving of 40,000 rupees under the old tax regime. Now, over here in the previous slide, we have seen certain deduction that was taken. Now, we are going to have an understanding of what are those tax saving expenses and deductions. Firstly, house rent allowance, that was the first deduction that was claimed. Now, house rent allowance is given to a person if that person is paying rent for his employment purposes. Number one, staying in a rented place and paying rent for his employment purposes, and his employer is giving him some allowance to meet that rent payment, right? Now, here is a common notion, a myth, that the amount of rent that I am paying, that is the actual amount of HRA deduction, right? So people think that I am paying 15,000 rupees of rent or 20,000 rupees of rent. So the entire 15,000 or 20,000, whatever it may be, that will be deducted from my salary. Now that is not the case because as per the income tax rules, uh, there are three figures we need to see to determine what will be my deductible HRA, right? So the three figures that we are mentioning over here is number one, 40 or 50% of my basic. Number two, actual amount of HRA that I have received. And number three, actual rent paid minus 10% of the basic. Right. So 40% or 50%, here lies the confusion. When can I claim 40% or when can I claim 50%? Now, if you are staying in a rented place in one of the metro cities, in that case, 50% of basic will be applicable. Now, metro cities in this context is only four: Delhi, Mumbai, Kolkata, and Chennai. If you are staying in Noida or Gurgaon or Bangalore, these cities are not treated as metro cities as per the Income Tax Act. Therefore, you cannot go for 50% of the basic, right? So, compare these three figures. Whatever amount you are left with, you will be getting three figures, right? And whichever is the lower figure, lower amount, that will be taken as HRA deduction. Excuse me. Second point is leave travel allowance. Now, leave travel allowance is a allowance which you can get, a deduction which you can get if you travel during the year, right? So, if you are traveling during the year, in that case, the traveling expenditure to some extent can be taken as deduction. However, there are a couple of rules and certain expenses that can be claimed as leave travel allowance. First and foremost, there is a timeline within which you must be claiming the LTA, right? So, LTA is allowed twice in a block of 4 years. So, the present block has started from 1st of January 2022, and from that year onwards, you can claim twice, two times, right? Secondly, the allowance is you need to spend this money yourself, your dependent spouse, and your children. If you are paying the expenses for your parents, then it will not be covered. Your in laws, then it will not be covered. You, your spouse, and your children, they are actually covered. Number three is only to and fro expenses are covered. That too, if you are traveling via train or flight. Apart from that, no other expenses are entertained as deduction. If you are staying in hotel, then no, the hotel staying expenses cannot be deducted. If you have taken a cab, that expense cannot be deducted. If you have gone for a meal, then it cannot be deducted. If the to and fro expenses of your destination and to your point of starting, those expenses can be reduced. But it needs to be either via train or by flight. In case you are traveling via train, then AC first class to AC 3 tier or 2 tier tickets can be claimed. If you are traveling via flight, in that case, economy class flights are covered. For this, you may have to submit the boarding pass and the ticket to claim the deduction. However, it must be seen, or rather LT allowance must be part of your salary compensation. If your part of salary does not have LTA component, then you cannot claim LTA. So before claiming LTA, make sure you have LTA component enabled in your salary. Now, what are the tax saving another tax saving instrument? uh, One is EPF and PPF. Now, Employer Provident Fund and Public Provident Fund both are covered under Section 80C. Now, your employers deduct every month a certain amount from your salary, and that is shown under 80C. PPF is a contribution which you do on your own, and the maximum amount that can be deposited is 1.5 lakh rupees. Tuition fee, again, if your children are attending school or college or university, in that case, any tuition fee that you pay for their education or admission, that can be taken as deduction. However, any developmental fees or any donations or any of this kind, these expenses are not allowed. Right? However, that school needs to be within India. Life insurance policy, if you have taken a life insurance policy, or if there are any ulips going on, term insurance policy, all those policies, if you have taken, then the premium paid to keep those policies in force can be taken as deduction under 80C. Principal on home loan, if you have taken a home loan, any principal that you are paying, that can be taken as deduction under 80C. All right. What other options are there under ATC? First of all, pension plan is there. So if you are taking a pension plan from any of the institute, then that deduction can be claimed. The premium amount can be claimed as ATC. Now, we are going to talk about National Pension Scheme, NPS. Now, NPS has a very unique proposition as compared to other instruments. First and foremost, in NPS, you can invest in two ways. Number one, you can invest on your own, or you can invest through your employer. Now, we are going to talk about if you are investing on your own. Now, if you are investing in NPS, in that case, you get an additional deduction of 50,000 rupees from your taxable income. Right? Let's try to understand this proposition with an example. Let's say your home loan principal is coming to 1 lakh rupees, your ELSS is 30,000 rupees, and your BAF deduction is 20,000 rupees, right? So you have already exhausted your ATC limit. As we all know, the maximum amount that can be claimed under ATC is 1,50,000 rupees. However, if you invest in NPS, in that case, you can get additional deduction of 50,000 rupees, or whatever amount you are deducting, you are contributing, whichever is lesser. So, in this scenario, 20,000 in PAF, 30,000 rupees in ELSS, and 1 lakh rupees in home loan principal. If you again pay 35,000 rupees as NPS, then you can get that 35,000 rupees deduction under section 80CCD 1B. Second point is employer contribution in NPS. Now, you can contribute in NPS through your employer as well. In the if you decide to invest in NPS through your employer, then maximum amount that can be invested is 10% of your basic salary. right? However, there is a catch. If contribution in NPS is more than 7.5 lakh rupees through your employer, in that case, any amount which is beyond 7.5 lakh rupees will be taxable in your hand. So be mindful of that. Now, we have discussed about how we can reduce our taxable outflow by 46,800 rupees in the earlier slides. Also, we have talked about how we can save 15,600 rupees if we are investing through NPS. Now, we are going to go through it once again. So, we have talked about 1 lakh rupees of home loan principal, 30,000 rupees of ELSS, 20,000 rupees of PF. Now, in this scenario, let's assume we are investing 65,000 rupees as my NPS, right? Now, out of this 65,000 rupees, 50,000 rupees is my maximum deductible limit. So, I will be able to claim a deduction of 50,000 rupees. Presuming we stay in 30% tax slab, 15,000 rupees we will be able to save that as tax, and 4% we will be able to save as education cess, health and education cess. So all in all, 15,600 rupees we will be able to save. Now, uh, here is an interesting proposition that what are the tax saving instrument that actually gives us a lot of benefit. ELSS is one such tax saving instrument which has a unique feature. That is, number one, it can save us taxes. Also, it can create wealth in the long run, right? So what happens is if you are investing in ELSS means equity linked savings scheme. So these are a specially designed class of mutual fund units. Unlike any other tax saving instrument under ATC, it has a very low lock in period. The lock in period for ELSS is 3 years as compared to 5 years to in tax saving FDs, right? So if you are holding ELSS units for a period more than 3 years, in that case, what will happen? It will be taken as long-term assets. Now, since they are equity-oriented mutual fund, the treatment of any gains that you may be having will be at par with equity mutual funds, right? So, if you sell these long-term assets, long-term capital gains will be charged. For them, you need to hold them for 3 years at the very least, right? Because there is this lock-in period. Now, if you are selling them after 3 years, you will be getting a long-term capital gains. Long-term capital gains is taxed in your hand at the rate of 10%. That too after giving you a deduction of 1 lakh rupees. So if your long-term capital gain is 70,000 rupees or 80,000 rupees, it will be counted as if income has been earned, but again 70,000 rupees is given to you as deduction. So the net result will be you need to pay no taxes, right? If the gain is coming to, let's say, 1,30,000 rupees, then 1 lakh rupees will be the deduction. And on remaining 30,000 rupees, you need to pay tax at the rate of 10% plus education cess or surcharge if it becomes applicable. Now, what are the ways you can save taxes? First and foremost, we can save the taxes using health insurance premium. Now, uh, we have lived through such a time wherein virus has been ruining our lives, and it is again threatening to wreak havoc in our day-to-day life again. So it's a very good idea to take up a health insurance premium, health insurance policy, wherein you need to pay a certain amount of premium, and if you pay it, there will be certain tax savings for you as well. If you are taking a policy for yourself, your spouse, and your children, in that case, maximum 25,000 rupees of deduction is available. If you are including your parents as well, then another 25,000 rupees can be claimed as deduction. However, if your parents are senior citizen, then this 25,000 rupees limit gets extended to 50,000 rupees. If your parents are not covered under medical insurance, In that case, medical expenses can be claimed in the income tax return. However, that will be limited to 50,000 rupees if your parents are senior citizen. Now, when I said that senior citizen parents are not covered any medical insurance, that means that any insurance policy, medical insurance policy of any kind, it can be a policy taken by you, it can be a policy taken by your employer as well. So if your parents are covered under any medical insurance policy whatsoever, in that case you cannot claim medical expenditure. Now, again, if you are supporting a differently abled family member, in that case, Section 80DD or 80DDB can be claimed deduction. Uh, Under Section 80DD, uh, any person who is disabled beyond 40% and less than 80%, 75,000 rupees as their medical expenses can be claimed. If that person is suffering from severe disability, that is more than 80%, in that case, 1,25,000 rupees can be claimed. ATU, the section similar to ATTD. However, for ATU, the person covered is the assessee itself, right? So, if you are a differently abled person and your disability limit is more than 40% but less than 80%, in that case, 75,000 rupees can be claimed as medical expenditure. If the disability limit is more than 80%, then 1,25,000 rupees can be taken as medical expenditure. Further section under section 80 DDB, if any dependent in your family is suffering from any diseases, which are terrible diseases such as cancer or Parkinson's, in that case, those expenditure can be claimed. However, for that, you need to have a medical certificate from a medical practitioner in prescribed form. Now, we are at the end of our session. We are going to take some question and answer right now. Screenshot, let's screenshot. Right. Since there are no question coming in, we are going to wrap this session right now. Thanks for joining with us. Hope you have taken some understanding of tax saving matters. Thank you. Have a great day and have a happy Christmas. Bye bye. Happy holidays.